For more on today's market action and gold's record-setting day, I want to welcome Dennis Hynes, Chief Market Strategist for RW Pressprich. Now, prior to joining RW Pressprich 2 decades ago, impossible to think about that, Dennis was a portfolio manager, futures trader, and commodity trading advisor. Dennis, good to have you with us on Bloomberg.
Nice to be with you, Pimm.
Now, Dennis, it must be, the market moves up today. You wear the double-breasted suit. Coincidence?
Tradition, a return to tradition. Yes.
What happened today in the market? Because if you take a look at technical levels, I've been looking, as you've taught me, look for 1130, 1131 on the S&P 500. We went right through that, closing 1142. Do we take out the confetti and start cheering?
Well, let me back up just a moment. Today on your network, you reported that the National Bureau of Economic Research said that the recession was over in June 2009. Then the National Association for Business Economics said, well, I think not. It ended in October 2009. And Mr. Bernanke steps in and says, well, I really think it was September 2009. When the best minds in the financial world have difficulty defining when the recession is over, what hope is there for the rest of us in trying to decide whether this is a bull market or not?
So what do we do then, Dennis Hynes?
Well, what we do is this, is we look at objective measures if we can. We try to avoid listening to the pundits. Of course, there are many, and they're all having conflicting reports. So we ask for some objective measurements. One might be sentiment indicators. There's the American Association of Individual Investors does a weekly survey which talks about sentiment. And once they get to extreme levels, if you're over 50%, if you will, okay, on the bearish side, okay, and for example, in March of 2009, we got as high as 70%, but oftentimes over 50% suggest that you've gone too far. And what we have now is at the beginning, it was August 26th, the end of last month, we were at 50% bearish, and in fact triggered this 10% rally we've seen. Now we're approaching the other side, 50% bullish.
Well, so, indeed, right in this weekend's Barron's magazine, there was that headline, "Where have all the bears gone?"
Abelson is right. Okay, they've gone into hiding.
For now.
Yes, temporarily. But I would suggest to you that you need to look at the sentiment indicators. Also look at price action. We've talked about, something which we don't talk about anymore. Back at the end of June, we talked about the death cross. It was a horrible thing. We said that the 50-day moving average moved below the 200-day moving average, which meant that there was a long-term, probably bear market beginning. We've stopped talking about that, but still, the 50-day moving average still lies below below the
short-term indicator that's lying below a longer-term indicator.
Which is suggesting to you that this is still, you should be cautious. How does an investor deal with this? Let's take a look. Now, today's high and today's close in the S&P, futures did not take out yesterday's high in futures.
That's Friday's high.
That's correct. Okay, Friday's high. It turned out to be, it was 1137.75. That's September futures. I know many clients don't look at this, but they really should be looking at it because that's where the market trades. So today we closed at 1137. So it didn't take out last week's high. So what to do? Please wait, unless you're very aggressive, please wait until Friday. And then let's see, we have new home sales coming up. We have durable goods coming up. These are two wonderful barometers as to how the market is doing. If the market then closes above the 1127 that we've been talking about internally, or above 1137 if you want to be a bit more of a skeptic, then great, please go with it. And what you'll do is you'll be bullish, and you'll be glad to be.
Boldly bullish.
Boldly bullish. However, should it not, then you will be advised to be cautious.
Be cautious, if not boldly bullish. But I love the way you technicians, you've got it. You've got both sides of the argument. What are we going to hear, do you believe, tomorrow from the FOMC? We're going to get some minutes released. Do you think we're going to get more of this unusually uncertain language?
Yes, because it is unusually uncertain. And that's really the problem. And we can segue into gold, if you will. But the currency of uncertainty is gold. Before, people always talked about gold being the barometer as to inflation. And then there were those who argued and said, well, wait a second, we don't have inflation, we have deflation. So then they said, well, we're not really sure what's going on, are we? So the currency of uncertainty is telling us that tomorrow the Fed is likely to say extended period of time for low rates, and there should be no expectation whatsoever of anything otherwise.
All right. We mentioned gold.
Yes.
A record.
Yes.
And I understand this idea of, okay, if people are worried about fiat money,
yes.
if they're worried about uncertainty.
Yes.
Gold ends up looking attractive to some investors. Is it possible for the stock market to rise and the price of gold to rise together?
Not appreciably. I think what you're seeing now is, and you've seen the gold come in off a little bit today. We've traded up to a 1285, 1286, and so I last looked, it was 1279 or thereabouts. Right. Okay, so what that means is, in the face of rallying prices, the uncertainty, a big part of the uncertainty is what's the economy doing and what is the stock market going to do as a result. Now, it's a discounting instrument, so if in fact stocks are going higher, the reason for uncertainty gets dismissed. But I don't think that's something that you should pay too much attention to yet until we find out how sustainable this rally is.
What about cash balances that portfolio managers might have that they were waiting for some sign that it was okay to start buying stocks again? I mean, we're getting to October, and there are not that many months left to the year. They're going to have to show their performance numbers. Is that going to drag more money into the market?
It clearly will. And we have this incredible herding mentality now. You know, there's very little
correlation, right?
It's true. Tremendous correlation. And for example, you'll have an 83% correlation on crude oil. So if you want to know what crude oil is going to do, just look at what the stock market is going to do. If stocks are going higher, crude will follow. So what should people do with cash on the side? They should put it to work with a requisite close at the end of this week.
We've got to look to Friday. That's the important close.
Yes.
Now, when you're looking at all of these technical market indicators, how important a role does volume play, the number of participants actively trading?
Number one is price. Number two is volume. Volume confirms price action. You must accept today's rally was not on incredible volume.
That's right.
So therefore, it didn't give you the necessary feeling of comfort that there were a lot of people doing this. There were not a lot of people pushing the stock market up. So volume is critical to confirming price action. We didn't have it today. I would like to see volume increase above this level on a weekly basis. And if it does that, I will then fall in line.
All right, then you'll be boldly bullish.
Yes, I'll be boldly bullish.
I want to see what suits you wear when you're boldly bullish, Dennis Hynes. All right, we talked about gold and the action in equities.
Yes.
What about interest rates and bonds? We've seen that has been the story for at least the half-year period. So much money going into the bond market, particularly government bonds.
The argument still is, if you had to favor one side of the argument, inflation versus deflation, it's deflation. And that's what you've heard people talk about, and even someone, I think, and I don't want to misquote someone, but I think there are some very reputable large firms saying that the Fed is coming in with perhaps $1 trillion worth of buying on the long end. Well, what does that mean? That means that the one place you want to be is on the long end. And we've talked about
you want to be on the same side of the trade as the Federal Reserve. They're buying,
absolutely.
You buy.
They're buying, you just let's tag along with them. Now, what is indicative of whether QE2 is stealthily in place? Well, I think what you've seen is we currently have the 10-year at a 270 yield. These round numbers are very important. Now, 260 means something, but 250 means more. So if you get the market to close below 250, irrespective of what people are saying, Fed officials or otherwise, the market closes below a 250, it's going to 2%. And it's suggesting to you that the fear of deflation is paramount.
But do you believe that that is what's going to happen? Because you're mentioning these economic reports that we're going to get later on in the week, and you mentioned previous economic data has been surprisingly strong to many economists. Indeed, that would argue for what? A rise in interest rates.
Yes, that's the reason that I practice what I preach, and that I listen to so many people who are so intelligent, and they sound so reverent. I listen to them, and they preach to me, markets going higher, markets going lower, and I'm constantly batted to and fro.
Sounds like a whiplash market.
Yes, exactly. So the way I deal with this is I keep myself objective by looking at price action. And I say to you that you close under a 250, you're going to 2%. And yes, what does that mean, QED? It means deflation, irrespective of what pundits are saying.
How do you maintain that discipline when you're getting this information that can be so discordant, can be so much of a cacophony out there?
Wonderful. Precisely because of that, I can do no other. If I sit there and discuss things with you, very bright fellow, convinces me to go one way, another bright fellow convinces me to go to another way, and they're at opposite sides of the same coin, I'm nowhere. So I have to come up with my own methodology. My own methodology is what I perceive to be an objective measurement of sentiment and price action.
And have you had to change that methodology over the years?
I've refined it, but it's become more and more, it's the absolute, with certainty, is the way I evaluate markets, because it's the only thing that has allowed me to be resolute in my approach to market.
It sounds like it's almost the footnote to the market, which is that there are a lot of smart people, but nobody really knows anything.
Well, that unfortunately is true. And the smarter you are, oftentimes the bigger the mistake you make.
Well done. Thank you very much, Dennis Hynes, RW Pressprich. Appreciate your insights, as always, into where the market might go.